Assalamualaikum and hi, my name is SYAFIKA binti MOHAMAD. I'm from BA242 Today I would like to present about the difference between conventional finance and Islamic finance. So let's start. First, what is conventional finance? Conventional financing is a transaction based on interest rate for saving surplus or deficit spending units to loan or borrow funds in financial markets. In conventional financing, lenders lend to borrowers to make a profit from the interest charged on the principal amount. It also a home financing scheme offered by financial institutions or banks which are not guaranteed by government agencies. Next is Islamic finance. Islamic finance or Sharia compliant finance refers to finance or banking activities that adhere to Sharia Islamic law. Two fundamental principles of Islamic banking are sharing of profit and loss, prohibition of the collection and payment of interest by lenders and investors. Value proposition. Value proposition is a promise of value stated by a company that summarizes how the benefit of the company's product or service will be delivered, experienced, and acquired. Essentially, a value proposition specifies what makes the company's product or service attractive, why a customer should purchase it, and how the value of the product or service is differentiated from other competitors. Next is structure of conventional finance. The basic difference between Islamic banking and conventional banking is the structure of how the bank is set up. For a conventional banking, the purpose of set up is to collect deposit and to give loans. This is the shareholders' understanding of what it should be. Two very distinct functions is collect deposit and give loans, and the arrangement is managed by a treasury function which tries to balance the returns to shareholders' funds. So, here is the conventional banking structure activities. Structure of Islamic finance. In essence, how an Islamic bank is supposed to be set up is based on the theory of sources and application of funds. There should be a single flow between the deposits and the financing or investment use of funds. This means there is no distinct function. It is a single function where customer deposits or investment pool is used to fund financing portfolio or deploy into investment instruments, from which returns are derived and recognized. Once the returns are determined, the returns are shared between the bank and the customer. Operating mechanisms are the means of control over the pace and direction of an initiative. This is the simplest, tough still critical of the elements. Operational mechanism for conventional finance. Allowance of interest and usury in financial dealing. Financing in all business. They not avoid any prohibition of Sharia law. Example, pornography, pub, dance club and other. allowance for investing in banned industry sectors. Activities such as pub, pornography, dance club, and others are unlawful. Lastly is profit and loss sharing. There is no fixed rate state. Operational mechanism for Islamic finance. Prohibition of interest and usury in financial dealing. Islamic finance does not and should not deal with money directly, and money cannot create more money by itself. It's only a medium of exchange. All activities must be free from interest. Avoidance of maizir. All transactions made by Islamic finance institution must be free from element of gambling. Profit and loss sharing. Bank share profit made with customer on agreed profit sharing ratio. Financing for only halal permitted business. Avoidance of gharar. This is free from uncertainty because gharar may dispute caused by injustice in the contract. Instrument offered. In conclusion, with increasing maturity of Islamic finance, the difference between Islamic and conventional loans products have narrowed considerably. But Islamic finance is better than conventional finance because it follows the Sharia law and free from prohibited elements. That's all.